I want to move to the stock market, which is really my bailiwick. I'm the stocks guy at CNBC. In case you're wondering, Greg is not like a strategist on Wall Street. He doesn't give year-end S&P 500 targets. But you did say in January that you expect averages for the stock market for the next several years to be below average, and you used the range there, 4.7 to 6.7%. And folks, if you don't know, the typical very long-term range in the stock market, the S&P, is in the 9 to 10% range. So you're essentially saying that stock market returns will be below normal for the next several years. What is your thinking on that? Why?
The primary driver, Bob, has really been around valuations, right? So when you look at where PE ratios are today relative to what they've been historically, much of the growth that we've seen in the equity market has been valuation expansion, in addition to earnings growth. But that valuation expansion can't continue indefinitely. And so when you look at the U.S. market relative to the international markets, those valuations are a bit out of sync. And so, yeah, over the last 10 years, we've seen U.S. stocks outperform international stocks by 8 percentage points a year over a decade. It's very unlikely that we're going to see that persist for the next 10 years, and that's why we're expecting U.S. equity market returns to be somewhere in that 5% per annum over a 10-year period.
It's largely a reversion to mean call.
That's exactly it.
International would not normally underperform for this long, number one, and valuations,
are the big driver.
PE multiples, would not normally stay this elevated.
That's exactly it. And so for the international markets, we have return expectations that are between 7 to 9%, call it 8, just to meet in the middle. But again, that's over a 10-year time horizon. And the other thing you have to keep into consideration is like the implied equity risk premium. What are you being paid to invest in equities relative to a 10-year treasury? In the U.S. market, it's not as compelling. It's about 2 percentage points lower than the long-term average. When you look at the international markets, investing in equities there relative to bonds is actually more attractive from an equity risk premium standpoint.
Yeah. It's very difficult, you're right. And the viewers, even without being able to define what an equity risk premium, which is, as Greg said, what you're getting paid for the risk of owning equities that are riskier than bonds, even without understanding what that is on an academic level, the viewers seem to understand it because they're sticking with their 5% treasuries. So they understand that the equity risk premium, even if they can't define it, is actually very low.
That's right.
It's like close to zero right now, actually. It's below 1% for a while. We don't
about 40 basis points, whatever.
Yes. Nerd over here. Of course, you got to know it. He knows exactly what the equity risk premium is. He gets up every morning looking at it.